brought to you with the kind support of Federated Hermes Inc., a leading global investment manager. Guided by their conviction that responsible investing is the best way to create wealth over the long term, their investment solutions span equity, fixed income, alternative and private markets, multi-asset and liquidity strategies, and a range of separately managed accounts distributed through intermediaries worldwide.
I come from a family of strong women. One example was a maternal grandmother. She was widowed at a very early age. She had to manage 7 kids and run a farm. She strongly supported all of her daughters pursuing further education. And that was back in the 1950s when, it was much less common. So I was never given the idea that there was anything you can't do.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Sinead Colton Grant, who is Global Head of Investor Solutions at BNY Mellon, based in New York City. She has over 25 years of multi-asset experience across investment and wealth management in both Europe and the US, and started out in derivative sales and later currency management. Welcome, Sinead. Thanks for joining me today.
Thanks very much, Aoife.
Well, let's start with talking about where you grew up. I think there is an Irish connection that we have in common there. What you studied and how you came to enter the world of investing.
Sure. And yes, I am from Dublin in Ireland. And look, I always think it's a series of steps that take you on a path. I mean, if I go back to, way back to when I was in school, my favorite subjects were maths, business, English, and that put me on a path to deciding to study business at university. Now, I attended an open day at Dublin City University, which was one of the newest universities in Ireland at the time. And what really impressed me was how modern that curriculum was. When I was looking at courses at other universities in a similar area, they seemed dated. And the other thing I really liked about what DCU was doing, in addition to very modern coursework, was that they were very aligned with what business needs were. So the courses included a 6-month work placement, and I suspected that having some practical experience would be very valuable. It was also a very small college at the time, 3,000 students. And in my 3rd and 4th year, I was studying international finance. That was one of the subjects that I had chosen. The lecturer was fantastic. She was an investment manager at a firm in Dublin. So when she spoke about markets, it was really based on what she was living day to day. And the timing was perfect. I mean, we'd had a couple of very interesting episodes in markets. We'd had the exchange rate mechanism crisis, the ARM crisis in 1992. We studied that. We were living through Greenspan's Fed rate hikes back in 94, which really upset markets. And so she had an ability to make all of this come alive. And that's what really sparked my passion for markets and for investing. And from there, I joined Chase Manhattan Bank in London as the graduate on their trading floor development program. And that lecturer ended up being one of my references for that very first job. So my introduction to finance was through a trading floor. I was one of the only, in fact, I was the only female on the trading floor graduate intake. And the trading floor overall was less than about 10% women. And if you can believe it, Chase Manhattan actually had one of the more diverse trading floors. So it was a very interesting introduction to finance. But I worked on the trading floor for 2 years. It was a tremendous experience. I learned a ton about markets. But one of my clients was JP Morgan Asset Management. There was an opening in their trading team. And one of the things that I realized as I spent more time in the finance arena was that I was much more aligned. My approach was much more aligned with the long-term focus of investment and asset management. And that was really how I felt I could add value. The thing that was really interesting about the JPM opportunity was that they were one of the largest active currency managers. So it was a great opportunity on the JP Morgan investment management trading desk to learn more about active currency management while still maintaining a link to trading. So I did take that opportunity. I joined that team. I built some great relationships with the active currency team and then joined them as a portfolio manager after a year or so. So that was really how I got started. But, I would also say that, I come from a family of strong women. One example was a maternal grandmother. She was widowed at a very early age. She had to manage 7 kids and run a farm. She strongly supported all of her daughters pursuing further education. And that was back in the 1950s when, it was much less common. So I was never given the idea that there was anything you can't do, in a very Irish way, very understated, but the belief was always there that, you should try. So I was very fortunate in that respect. And looking back, I think there were also some very subliminal effects. Having that female lecturer in finance, it never occurred to me that there would be so few women when I actually joined the financial world.
It seems that your course was unusual in having that practical element and that link. Often, I believe, I studied law, and whatever you study in the classroom is quite different from what you're doing in practice. Did you find that your skills were quite translatable immediately onto the trading floor? And was there an element of apprenticeship too that went on once you got to that floor?
Well, I think the trading floor environment is a very particular one. It's hard to think of anything that would adequately prepare you. I think the practical element of the courses in DCU, I worked in an area where we did valuations for insurance portfolios. And so that gave me an insight into how individuals think about investing. But I think moving to the trading floor environment, I think some of the insights that the lecturer gave in terms of how markets behave and in terms of how you can apply that knowledge practically certainly came through. But it is very hard to replicate a trading floor environment anywhere outside of that.
Very interesting. And now that you're looking from an allocator's perspective, what do you enjoy about the investment world and the allocator's role in particular?
There are two aspects that I really enjoy. The first is, it's a much more long-term focus. And I think markets they're very efficient in general, but they incorporate an awful lot of short-term noise. And so what I enjoy as an allocator is we're looking at developing those long-term strategic allocations to meet investors' goals over the long term. And it's really looking through that short-term noise to identify opportunities. Some of that is focusing on where we see opportunities in private assets, where they are less exposed to that day-to-day noise. And in public markets, it's where, the volatility is what gives you opportunities, but it's all about focusing on that long-term goal. And then the second piece, to me, it's always got to be about purpose, right? So when I think about generating investment returns, it's always about meeting another goal. So whether that's for a pension plan whose ultimate aim is to pay pensions to their employees, foundations and endowments where they are either funding education or perhaps some other element of what the endowment or their foundation may be focused on, and where you're enabling them to continue spending on and investing in research, or whether it's helping individuals to reach their goals, individuals or institutions. As part of my role, I lead the responsible investing practice at BNY Mellon Wealth Management. And that's something where we've seen an enormous sea change in the US over the last number of years. It's increasingly a focus for investors, whether it is for individuals or institutions, and really being thoughtful about the impact that your investments can have. But one of the areas that I feel very strongly about is around financial education, because finance impacts all of us, regardless of whether we work in the industry or not. There was a recent study carried out by BNY Mellon Investment Management, which really, for me, hit close to home, because it was focused on women and how they invest. And it was a very broad survey. But one of the metrics that really struck me was that only 28% of women felt confident about investing some of their money. And that is a real issue in growing long-term wealth. And it has impacted the individual level, but also at the societal level in terms of the economy being smaller as a result. And so, having the ability to have some influence on helping investment, whether it's institutions or individuals, is really important for me personally.
Well, thank you for that. And we will talk a little bit more about ESG just a little bit later on. I want to first of all dig into the term solutions, as that's in your title. And it's certainly, the concept of client solutions is something we've seen evolve, and there is a role at most asset managers now. What do you understand by the appetite for solutions and the term solutions? And how is that evolving over time?
It's a great question. And look, I think the industry finally realized that most clients they define success differently than the way that the financial industry did for an awfully long time. So to me, the focus on solutions really means focus on an outcome. It means less of a product focus and really orienting investments around achieving that outcome. So for a pension plan, that might mean increasing their funding ratio. For a foundation or endowment, it might enabling investment returns such that they can continue to have a particular rate of spending. And for an individual, it could be anything from ensuring that they have sufficient income in retirement. It could mean focusing on the amount that they can pass on to the next generation. But when you get down to it, I think for the longest time, we as a financial industry, how we defined success was relative to a benchmark. So let's say, MSCI World in equities, and success was viewed as outperforming that benchmark. And, and that definition of success did not change whether the index was up 10% or down 40%. And I think a lot of this came out of the financial crisis back in 2008, where it became very clear that the investor's experience of that was not aligned. Very hard to talk to an investor about how, well, look, I've done a great job because MSCI World is down 40% and I'm only down 38. And so therefore I've done a good job, because that does not feel like a good job to the investor. And so aligning the total return and the outcome that is generated is much more aligned with where or how a client thinks about success. And that's really what we mean about solutions. It's reorienting that discussion around what the client or the investor is trying to achieve, rather than how the industry might have traditionally focused on a product lens where it's much more benchmark versus the performance delivered.
And how about alternative assets? How do they factor into solutions today?
They increasingly play a big role. One of the areas that my team focuses on, and every year we update our capital market assumptions. So these are the long-term expected returns for asset classes, typically with a 10-year horizon. And that informs how we construct portfolios. And one of the aspects that we have seen come through very strongly is that, given the very strong returns that we've seen to traditional assets over the last few years, we expect that the return to those traditional assets will be more challenged looking out over 10 years. Now, that's not to say we won't see a strong year for equities, but when you're constructing those long-term portfolios, we expect the return to traditional assets will be challenged, and that's both public equities and in traditional fixed income. So increasingly, we're looking to alternatives to really provide that additional boost to return and play a larger role in portfolios. And look, this is something that we've seen endowments do for a long time. They recognize that there isn't an immediate need for liquidity in all aspects of their portfolio. And so they want to really take advantage of that illiquidity premium. So when we look at allocations over those horizons, private markets asset becomes increasingly important, as well as the role of liquid alternatives to act as alternative diversifiers to fixed income. There's certainly still a role for fixed income in portfolios, but given the outlook for inflation, given how we expect yields to behave, you need an additional ballast in the portfolio in the form of a liquid alternative. And private markets, one of the increasing trends we've seen over the last 10 years or so is just a reduction in number of public companies. And not only that, but when a lot of private companies are going public, they're not small. They're heading straight into the S&P 500. And so investors really miss out if they do not have that allocation to private markets. And again, it's not about putting, 50% of the portfolio in it, but it's a meaningful allocation within the portfolio in order to capture those returns that, frankly, 20 years ago, you might have been able to get through public markets.
And it's interesting, just circling back to your point about financial literacy and comfort level, given the complexity and some of the, I suppose, the mislabeling of some alternatives, it is an area perhaps where clients feel less confident and less knowledgeable. So I think even more reason for that education approach when you're bringing it as a solution.
Absolutely, for sure. And I think one of the areas that we will need to think about as an industry is how we enable individuals to have exposure to those private markets. Think about 401ks, think about individuals. There's such a focus on daily liquidity, whereas for the most part, that's actually not needed. And what it is resulting in is an inability to access those private markets where some of those higher returns are likely to be generated.
And I haven't actually had many currency experts on this podcast, so I'd love to dive into a question that often comes to my mind, which is your thoughts around using currency as perhaps a solution for alpha, actually generating alpha in a currency management strategy. Or how do you think about how clients should approach currency? Should they just let the exposures fall out naturally from asset allocation? What's your view on that?
So there are two components to this. One is how you think about currency from a long-term strategic perspective. And the second is how you think about it tactically to generate alpha opportunities. Look, over the long term, the expected return to currency is zero, but the long term is very long. And so when you look at currency movements over a month or a quarter, or even a year or two, there can be some very significant movements. Now, when you separate those two out, I would say a lot of investors leave currency unhedged. They just let it flow through from the underlying investment. And that is attractive because it means you don't have any cash flow implications coming through from hedging. But ultimately, it's about a risk decision. If you look at, for example, an allocation to non-domestic stocks, and let's say that that has a risk level of 15% or so, if that allocation, exactly the same allocation, is currency hedged, you'll reduce that expected risk to about 13%. So understanding the risk tolerance that you have, because ultimately that's risk budget that you could deploy elsewhere. But what the approach that we take is to look at the overall risk appetite that a client has and frame their currency hedging in relation to that. And then ultimately you apply a practical overlay. So for a lot of clients, what we find is that purely from a mean variance optimization perspective, the optimal hedge ratio would be somewhere between 50 and 75%. However, currencies move around a lot. And if you're hedging 75% of your currency exposure, you have to be able to find the cash flow to meet realized losses that might occur from your currency contracts. So practically, we find that if clients are looking at this, typically they settle around the 50% level because that just makes those underlying cash flow requirements more manageable. And it still reduces a meaningful proportion of risk. So the second part of this is, can you generate alpha? You absolutely can. And you have to think really about what influences currency markets. They're very different than underlying equity, than underlying fixed income, where it's all about that specific market. With currencies, everything is relative. It's the price of one currency in terms of another. What I love about it, but makes it particularly challenging to identify opportunities, is that it's affected by everything from, economics to politics, relative interest rates, risk aversion. And so it requires a very different approach than managing equities or fixed income or really any other asset class. It also needs to be highly tactical. So I would say that yes, you can generate alpha, but it's probably more realistic to expect that it's a dedicated currency manager that can deliver that alpha rather than an equity or fixed income manager that is doing it as a piece of what they do in other parts of their investment process.
Very interesting. Well, thanks for giving us the two examples there. And I want to go back to your point about ESG, because you mentioned that you're focused on the wealth management space. And certainly ESG, I feel, has been driven primarily initially by the institutional space, as they have the stakeholders perhaps pressing for divestment or pressing for investing in a diverse manager slate. What are the factors that are really top of mind in the wealth management segment when it comes to ESG? Is it around climate change resilience? Is there as much concern perhaps about governance or board director composition?
It's a great question. And, in terms of the investing world, I would say the focus of clients can be quite different. And while I work with the investment management group, and obviously that is for individual clients, the investor solutions business is actually more institutionally focused. So what have we been seeing? Well, increasingly, we see that clients want their investments to be aligned with their values. And I would say one of the largest differences, and we work with clients globally, one of the largest differences we tend to see is in Europe, there will often be a much bigger focus on climate and the environment. And in the US, that's certainly important, but there's a bigger focus on racial and social equity. And there are a couple of discussions that we have with clients. Sometimes they will come to us and say, I don't want to have any fossil fuels in my portfolio. Help me think about how I can construct an allocation that excludes them. And what we believe is really important is to understand what you give up by doing that, because you give up the opportunity to engage. And some of the firms that perhaps would score poorly today in relation to fossil fuels and emissions, they're exactly the companies that we need to engage with in order to bring about change. And very often, as that conversation evolves, there's a recognition that actually it's better to be part of the discussion and influence change for good than to just step out of that conversation entirely. So that's one aspect. Often we work with multi-generational families, and there the perception can be quite different across generations. And in order to impact the investments, that you need to get to a common ground. And what different generations are focused on can be very different. So, for example, in discussions around racial and social equity, we have found sometimes that it's the younger generations that really want to push this forward, and to the point where there's a clear desire for metrics in terms of the change that you can bring about. For some of the older generations, what really brings it to the fore for them is the economic argument around if you expand opportunities, you expand GDP within an economy, and ultimately you expand the taxpayer base. So it's about understanding what portions of the discussion really bring this home to people. And then with institutions, often we find that they are very focused in the areas that they want to engage in. When we look at, and we use the term responsible investing, there are really 4 categories that we look at. There is screening, which could be positive or negative. There's ESG integration. And this is what we see predominantly in public markets, where it's about that ongoing engagement, where voting proxies, engaging at AGMs is incredibly important. And that's where there's a big opportunity to influence change. The third type of portfolio is thematic, where you may have a portfolio that's specifically focused on renewable energy, for example. And then the fourth is impact. So impact, we think, is quite challenging to have in public markets, because impact needs to be not only about the financial return, but also a measurable additional impact in whichever area that you may be focused on. And we think private markets they're really our area that we focus on for impact. So that could be around affordable housing, that could be around renewables, it could be around inclusion. But I think the biggest challenge in a space is the measurement of those, and making sure that, because we don't manage directly, and making sure that the improvements are being measured accurately, and that we really are going to see the impact that we would expect.
And just going back to a particular aspect of ESG, and it's interesting, I think, that you mentioned it has to be tailored in a way, just like your solutions are tailored very individually around the clients. Diversity itself, you mentioned when you joined the trading floor being one of a minority. How do you think the investment industry is improving or not, as the case may be, with respect to diversity? And maybe if you chart it over the course of your career.
Yes, great question. So look, undoubtedly the industry is a lot more diverse now than it was 20 odd years ago when I started. And I think a few things have happened. First of all, I think corporations have realized that more diverse perspectives enable them to make better decisions, and ultimately it's good for business. Secondly, I think that you've seen a generational shift where the client base has become more diverse. I was listening to a podcast that Sarah Blakely from Spanx appeared on not that long ago. Obviously, she's just had a very successful sale, but the PE deal team that was put in front of her was all female, which I thought was fascinating. And ultimately, the client changes, and that leads to a change in how businesses react, because that is what their clients are demanding. So I would say we're seeing increased diversity across the board. The change isn't as quick as we would like it to be, because ultimately, that happens over time. But, I think the finance industry needs to do a better job of communicating that it is a better career certainly for women, because female representation is improving, but it's not at a level that we would expect it to be at. but we want diversity of all across all elements, because ultimately that helps us make a better decision. It helps create a more inclusive environment. And actually, on that point, it's not just about having diversity in the workforce, but it's about inclusion. Because if you don't have inclusion, the diversity piece really does not, you're not really seeing the power of it. So that's something I think that all companies need to focus on.
And just going back to some of your personal reflections now, were there any, over the course of your career, any challenges or setbacks that you have learned lessons from that you can share?
So one thing that came through to me very strongly, I think at the beginning of my career, I had the perspective that if I worked hard, did, everything that was asked for me and more, that it would all be recognized without me having to do anything in addition. And there were a couple of examples where I realized, oh, they really don't know what I'm doing here. I need to advocate for myself, explain how I am contributing what I'm doing. One, I can't just assume, because not only is that not fair to me, it's also not fair to the people that that I'm expecting to just magically know. And, as part of that, I realized that that's what other people were doing. Some of that may be cultural, but that was a big learning experience for me. And thankfully, I realized that quite early on in my career. But it's not always easy to do, right? But I think that is really important.
So it's such a good point. And I've actually heard even techniques about, how we should even journal these achievements, just to actually write them down and to be able to express them when it comes to giving examples, maybe in a review. And I saw another recent metric, which was charting not just competence, but criticality of an individual in an organization. And really, that's what ultimately really should determine comp, and how we must obviously make an effort to ensure that we are seen as being as critical as we are, and not to underestimate that element. But yes, speaking up, unfortunately, things do not speak for themselves. So that is an excellent point.
And by the way, I did exactly the same thing. So when I realized this, I started making a note during the year of all the things that I was working on, so that when it got to mid-year reviews, year-end reviews, there were proof statements. Because, I think we all tend to get caught up in what we're working on at the moment. And, with that kind of strategic thinking throughout the year is really important.
And when it comes to mentors, did you have a particular mentor or any key person who guided you throughout your career, or maybe even from a different realm, from outside your career, that influenced you?
Yes, I did. And it's fascinating because as I start to think about it, they took different forms. I would say probably none of these individuals would have thought of themselves officially as my mentor. And sometimes I think we lose sight of that, right? Mentors are very important. Sponsors are very important, but it doesn't always have to be a formal relationship. So certainly that lecturer I mentioned back at university, absolutely that person was a mentor, because they showed me a path. When I was early in my career at JP Morgan, there was a woman appointed to lead the group that I was part of. And, seeing how she ran the group, seeing her in that position of seniority, again, it comes back to, you need to see evidence of what's possible. So that was very important. There was a male mentor who really shepherded me through many parts of my career, gave me great advice, and really helped me to become the investor that I am today. And then when I think about now, it's part of it is mentorship. I think sponsorship is really important. And that's what I really try to do for people who are earlier in their careers, because as I view it, mentoring is about helping to advise, but sponsorship is really about promoting people within the organization, and in particular, putting them forward for opportunities that where others may not be as aware of how capable they would be.
Those are excellent points there. And in terms of any words of wisdom or pieces of advice, is there anything that you have let guide you through your career so far?
So I would say there are, well, first of all, advocate for yourself. I mean, that is one of the biggest points. Do not hide your light under a bushel. Be very clear about what you have achieved, what you have contributed, and communicate that. And I would say as a leader, there are 3 key areas that I focus on. And it's really communicate, to make sure that my team is aware of what our goals are and how we're going to get there. Delegate, and then hold accountable. I mean, I think all of those three things, each of us can leverage in our own roles. I think those three things are really important, and particularly holding accountable. And that is where we need to make sure that everything is clear and measurable. And with those guiding principles, it helps me to think through different opportunities, because it allows us to be very clear on what our end goal is, develop a plan to get there, and be able to identify when things have gone off track. And I would say some of the times when I've learned the most have been when things are not going according to plan. And I've been able to track back to say, where did this go astray and why?
That's great. And when you use the words hold accountable, I was thinking there are different ways. Obviously, you can hold yourself accountable. It's also possible, and it's easier said than done, perhaps, to build a group of people around you who hold you accountable, like your personal board of directors, so to speak. That is a good reminder as well, that we have certain to hold ourselves accountable to others, in terms of what we can achieve. My last question is around any advice you would have for your younger self. Is there anything you know now that you wish maybe you had known as that young student entering DCU?
I think one of the biggest things that I would have advised is you have a voice and you should use it. I think when I joined the trading floor, none of my family were in finance, in that type of finance. So there were a few accountants, there was an actuary, and nobody worked on the trading floor. And, that was quite a culture shock. And I think when finance in London was, quite traditional, I think you need to be very aware that your people have trusted you. They put you in a position because they think you have an opinion that is valued. And obviously you want to take some time to learn your craft, but to be more vocal from the outset and recognize that the diversity of opinions is really valued.
That's an excellent point. Somebody else, Andrew Asayami, who was from South London, Nigerian origin, went on a trading floor, and he talked about in a previous podcast learning to use his voice. And in his case, he thought that that the right way to behave would just be keep his head down and do the work. But he realized that people had actually employed him because they wanted to hear about for his authenticity, and he was required to use his voice or he might not have a future there. So it was a very interesting support for that argument about the importance of finding the voice.
Well, I think also it's about finding the people that will actually be honest and frank, not constructive criticism, but I think there is a danger that you don't really get the honest feedback, and you need it. We all need it, right? And I think as part of that, building that network, right? I mean, it's partly about holding yourself accountable, other people holding you accountable, but it is also about, make sure that you really understand what the situation is so that you can learn and grow. Because I'm a huge believer in feedback, because without it, it's very hard to know maybe the areas where you could improve. So feedback is hugely important.
Well, thank you so much, Sinead. Thank you for being a voice, not only for your female clients, as you mentioned that financial literacy is so important to you. They will be the client base of the future that we need to bring to the table and ensure are confident, but also for females in the industry, and for being such an extraordinary role model yourself. It's been a pleasure to speak with you here and to hear your insights.
Thank you, Aoifinn. It's been a delight speaking with you, and thank you for having me.
I'm Aoifinn Devitt. Thank you for listening to the 50 Faces podcast. If you like what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.